what is different between an investment trust and a fund?
A fund is a pot of money that is manufactured and administered and sold by an investment manager. So if you want to invest in a Fidelity unit trust, effectively you go to Fidelity. So the buy order goes into Fidelity and they offer you the units. When you sell back, it's actually Fidelity who send the check back out to you. With an investment trust is a company. It's Murray International Limited. It's F&C Limited, JP Morgan, Claverhouse Limited, and they're all listed on the stock exchange. There's a very fundamental difference that where I think the penny will drop for most people. If you want to invest £50,000 in Fidelity situations, you give Fidelity 50,000. Their funds under management go up by 50,000. If you want to invest £50,000 in Scottish Mortgage, so the investment manager for Scottish Mortgage is Baillie Gifford. You don't give 50,000 to Baillie Gifford. You have to buy those shares off someone else in the market. So Baillie Gifford's money under management for Scottish Mortgage never changes. You go and put £1 million into Scottish Mortgage, they don't make any money out of it. When you go onto the interweb, you don't have marketing departments for investment trusts. You have marketing departments for open-ended funds because that's how they get more assets under management. It's simple. It's the business model.
Right. So that's as well where the opportunity lies, because you prefer to have a fund that spends less in marketing, potentially, more somewhere else. So I have this aha moment.
So the average AMC that we'll see on an investment trust will be between 60 and 65 bits, something like that. Some of them, you go down to 30, 35, which is just value for money. So we're income specialists, so we're only really interested in the income-focused trust, which means they tend to be older, they tend to be bigger, and we measure it by the income that they throw out. We don't measure it by the cost. Cost is a consideration, but it's not all.
People was trying to probe a bit more this. How old are they? 150 years old or something like that?
Yeah, 156.
That does feel a market. I guess one of my worry might be, are they keeping up with the times? Are they making the most of, for example, technology and stuff like that? And also, what's driving them?
So you're asking, is it efficient? Efficient for who? Because you as an investor, George, are very different to my mum. You're different from the person out on the street. The luxury that we have in Chancery Lane is we are only interested in income-based assets. That means the question you're asking is it efficient for capital distribution, taking into account new technologies? I don't really care. They might be, but that's not what we're investing.
Let's just measure it by the income distributed. What I'm trying to figure out is what drives them towards, doing the same or better.
Because it's a company, and the front of its annual reports, they're required to state this is the objective of the company. Now you get some investment trusts that'll say we're looking at, investing in bottom up or top down and making money over the long term. That's no objective at all. I mean, that's just an absolute cop-out. So when you go and look at F&C, it's looking at growing its dividend, growing the income stream through its dividend stream that is related to inflation or higher with underlying capital growth in its shares. You go back and track its record, it's knocking it out of the ballpark. It's that successful. The reason it's that successful, by the way, is it holds about 12% of its assets in private equity. These investment trusts were first created as the first pensions. That's why they were set up, so that people could disappear to India or the Caribbean in the late 1800s and know that their money was set up and taken care of if they didn't come back, either for them when they retire or for their families. That's why these were first set up. And they're still going strong. So do they work? Yeah, they do work.
What type of assets do you invest in? They invest in public stocks and also private?
So an investment trust that invests just in property is called a REIT. So you have things like supermarket income REIT, and all they do is they buy and lease back supermarket properties to Tesco, Sainsbury's, and people like that. Then the main ones are multi-assets or very investment focused. So you'll have international equities or you'll have emerging. So Schroeder Oriental, you can tell it in the name. Murray International, you can tell it in the name. And then you have ones like Scottish Mortgage who specialise in unlisted stocks and looking for stuff that's going to go through the roof.
That's a lot to reflect on. There's definitely a lot of value in thinking about what exists and what has proven its effectiveness.
It's looking at within the ecosphere of the investment market. Actually, there's lots of constituent parts, and those constituent parts do different things. So a lot of the master trusts do a fantastic job. They take the money in, but what they don't do is tell people this is what you're going to get. The interesting thing about the investment trust sector, if you just treat it as multi-asset investment, all of a sudden you get to be able to deal with the biggest problem that you'll hear from all the professionals working in the industry, and you'll hear it from politicians as well. Yes, but what about inflation? Inflation is solved if you look at it on a 5-year rolling basis. If you try to solve each individual year, you will get caught with the outliers like we had in 2022 when it spiked to 11%. But I can tell you that with our core research data that went back to 1986, running the investment trust dividend increases back to back with RPI, not CPI, it's 130% of inflation. It just completely destroys it. And you can look at that and say, yeah, one of the criticisms that sometimes get thrown at us is we need to run our data across a 100-year period for it to be statistically relevant. Well, I can show you absolutely staggering charts comparing the dividends from F&C Investment Trust against inflation. And bear in mind, F&C started in 1868, which is 9 years before General Custer fell out with Crazy Horse at the Battle of Little Bighorn. So they're still playing cowboys and Indians over there, and we were inventing investment trust. And F&C, so it's not guaranteed, and there is no employer underwriting it, but it's never failed to pay an income.
Some investment trusts
Yeah.
have spectacular discounts, etc. Overall, I feel like it's perhaps a segment of the industry that is not loved. And I have to contrast it with what's happening in the private market, where people seem to not be able to get enough of it.
The reason you get a disparity between the share price and the NAV is the NAV is the current market price of the assets that they hold. But the share price depends on the buyers and sellers. It's you and I buying and selling the shares of Murray International and the London Stock Exchange. And the two of them can split because the price is driven by the number of people coming in to buy. So technically, you could have an investment trust that only owns Shell stock. So you've got the share price of the vehicle and you've got the share price of Shell, and there can be a disparity between the two. It's a really simple way to outsource that income generation. They are fully wrapped vehicles. They're multi-asset and they've got reserves.